Greetings. Reggie Middleton. More financial thoughts for the day. I want to discuss the U.S. banks. The U.S. money center banks are going to enter into a strong cyclical downtrend. Strong as in 2008 style strong. To begin with, the Basel III Accords, which are the European global bank rules that global money center banks are supposed to adhere to, are basically making things much more stringent. Heavier capital reserves, more stringent definition on assets, etc. So the big banks are shedding assets to get smaller, particularly those banks that were very, very large to begin with. JP Morgan is a good example. They acquired, bought, got for free, etc., with promises and guarantees, Bear Stearns. Bear Stearns had a heavy prime brokerage clearing business. JP Morgan has actually gotten rid of the small and medium prime broker clients and the mini primes, basically those introducing brokers that bring large clients and medium clients, such as hedge funds, into the larger banks, such as Bear Stearns or JP Morgan. They did that in order to increase profitability and shrink their balance sheet. They've done quite a few other things. They've decreasing capital deposits, loans at risk, etc. Despite that, they still, in my opinion, are extremely large and extremely concentrated as compared to the JP Morgan before 2007. The big problem in the 2008-2009 crisis was the banks were too big to fail, hence they couldn't be allowed to fail. That's the story that was given. Well, fast forward to 2015, each and every one of those too big to fail banks are now too bigger to fail more. So if they were too big to fail back then, and they're bigger because they swallowed up all the other failing banks, what are they now? They're too bigger to fail. Despite that, if you take a look at JP Morgan's quarterly results, they're down, revenue is down across the board, every single major business revenue line. Not only is it down sequentially, it's down year over year as well. And there should be more of that. I doubt if it's only be JP Morgan, not picking on them, because you probably see the same from all the other big money center banks. Which is interesting because the business that we're in, Veritasium, which makes blockchain technology solutions for everyone, is in competition with larger, better capitalized entities. And these entities are chasing what I call the low-hanging fruit. They're going after the banking sector. They're trying to take this bleeding-edge technology and retrofit it into the legacy banking system. And the reason is because banks have a lot of money. And banks will give the money out in terms of business and investment capital. And banks are relatively low-hanging fruit. They're slow-moving. But the banking model, as we know it now, is obsolete. It's a dinosaur. It's essentially gone. It simply takes time. And banks are notoriously boom-bustic. And saying that, they boom and they bust. They follow the economic cycle with extreme leverage. So during good times, they hire, they spend a lot of money. During bad times, they fire, and they spend very little money. Well, you've heard thousands of layoffs per week or per month from practically all the major banks across the world, Europe, Asia, and the US. And the reason is they expect what JP Morgan is about to come through as well. So with that being said, basing a startup's business model on an industry that is obsolete as we know it today, going through a strong cyclical downturn, and faced with a large amount of regulation, I think that's the wrong direction. What we're doing is we're taking the entire banking function, we're congealing it in the software, and we're allowing the end user to deal directly with other end users on a peer-to-peer basis. We do this without touching any of the capital. We simply are a software provider enabling Peter to do business with Paul, whether it's lend money, borrow money, invest money, trade, broker, letters of credit, etc. Au revoir, until the next time.